December is not only the holiday season, but it is also the end of the tax year. Here with some end of tax year planning tips is Communications Committee member Mindy Avon of Mishawaka. Mindy, welcome to NAFA, Indiana this month.
Thanks for having me, Joe.
Mindy, you run a financial advisory practice. What tips can you share with our members about end of year tax planning?
We all know that tax changes are coming, right? But unfortunately, we don't have any definitive information, but I can tell you what's kind of brewing, and we'll just have to keep our ear to the ground and see what actually kind of shakes out next year. The Build Back Better plan, we call that the BBBA, Build Better Back Act. First of all, they were originally talking about increasing the top individual tax rate. They also were going to increase the top capital gains and dividend tax rate. And they were also going to increase the corporate tax rate. In addition to those changes, they had originally talked about accelerating the estate and gift tax exemption sunset from 2026 to 2022. They had originally suggested that they would include grantor trusts in the grantor's taxable estate, and they were going to eliminate valuation discounts for non-business assets. So that was in the original BBBA, but they've come out with a new edition, and that new edition did not include any of those original pieces. Now, what that means is potentially those pieces will not make it into the final bill. However, we can't assume that because they could come back into play. So again, those were things that were in there originally. Maybe you're not going to be there at the end, but we need to watch carefully. The items, though, that are included currently in the most recent version of the BBBA is a net investment income tax. So what that means is that there would be potentially a 3.8% net investment income tax that would be assessed, basically trading investments, selling a business, and anyone who has an income of $400,000 or more as a single filer, or $500,000 or more of married filing jointly taxable income. So potentially that's a new tax that we'll see. We're also seeing in this new edition of the BBBA a new tax of 5% being imposed on taxpayers' modified adjusted gross income, or their MAGI, in excess of $10 million. So now that does seem like a lot. That's a large income. However, there are people, that we serve that this would affect. The income would be $5 million that it would affect if they were filing separately, and $200,000 if it's a trust or an estate. So definitely could have some issues there. In addition, an extra 3% of tax on any modified adjusted gross income exceeding 25 million, or 12.5 million for people who are filing separately, or $500,000 of trusts and estate assets. So again, these are what would they call a surtax, a tax on top of a tax, and this would be effective in 2022. They're also looking at a new corporate alternative minimum tax. This would impose a 15% alternative minimum tax on financial statement income of corporations in excess of $1 billion. So you can see that a lot of these taxes, they're going after maybe the ultra high income, ultra wealthy. That new corporate alternative minimum tax would go into effect in 2023. Some changes when it comes to retirement plans. Again, this is just proposed. It's not, definite yet, but they included for people who earn $400,000 or more of income per year as a single, or $450,000 as married filing jointly. If someone had a retirement account balance in excess of $10 million, they would be prohibited from making additional contributions to their retirement accounts. And they also have some additional requirements. They would actually be required to distribute or take out 50% of their balance that was over $10 million. So for example, if they had a $15 million account balance, they would be required to distribute 2.5 million, 50% of the balance that's over 10 million. And if they had an aggregate account balances of all retirement plans of over 20 millions, they would have to deplete their Roth IRAs. So they lot of kind of negotiating around these retirement assets and what they would consider to be ultra high net worth or ultra high income. So definitely, and those changes would go into effect in 2022. So definitely this would be next year. Something that many of our NAIFA members have probably done themselves or have advised clients to do was the backdoor Roth, where people who earned more income than allowed them to make a traditional Roth IRA contribution, used non-deductible IRAs, made non-deductible contributions to an IRA, and then they would convert that money over to Roth. That is no longer going to be available. And actually, anyone really doing, no matter what their income is. So Roth conversions could be completely gone as of 2022. So again, we don't know for sure anything, if any of these are going to happen, but we do believe that there will be some, if not all, of these kind of tax situations. And of course, we advise our clients to talk to their tax advisors, talk to their attorneys, just to see, once these laws go into effect, what should they be doing, to prepare and to plan and to maybe avoid some of these tax situations. So keep your ears tuned. We'll see more after the holidays, I'm sure. And back to you, Joe.
Mindy, this sounds like everything is in a state of flux. What should our members do to stay on top of this?
Great question, Joe. For our NAIFA members, the best way to stay on top of these changes would be to subscribe to NAIFA briefs. And then they'll get updates as those NAIFA briefs are sent out, and they can read them. They're short, easy to read, and that way they'll know what's happening and when things do get finalized.
Thank you, Mindy.
Oh, you're welcome, Joe.